You can build yourself a dividend empire that can have you earning thousands upon thousands every single year. And the best part is the fact that that dividend income is going to continue to increase year in and year out through the process of what's called the power of compounding dividends. And in today's video, I'm going to show you exactly what this process is of the power of compounding dividends, how you can utilize it, and I'm also not going to leave you empty-handed. I will be giving you 10 of the best dividend stocks that are out there, not only in terms of share price appreciation, but also in terms of consistent dividend growth and strong dividend growth rates at that. So if you're excited and you're ready to build your very own dividend empire, then do me a huge favor. Click that like button down below, as that shows YouTube, if you like this video and this content, it'll show it to a wider audience, and I truly appreciate it. And subscribe to the channel, and let's get into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And let me begin by thanking today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their best stocks to buy right now. All right, let's get back to the video. And maybe you're already a dividend investor, or maybe you've been thinking about getting into dividend stocks. But there's some things that you've heard out there, like dividend stocks are only for when you're retired, or dividend stocks are only for those that have a lot of money. And those two comments, although they're the most common comments I hear all the time, they're not entirely true. Now, of course, if you start with a lot of money and you have a dividend yield, that's just math. But that doesn't mean that the process doesn't work irregardless of where you're starting. Everyone has to start somewhere. And I'm going to show you how the power of compounding can get you started with dividend investing. And piggybacking on that, the power of compounding is the one reason we don't want to wait for retirement. Through this compounding process, it will allow you to increase your share count over a number of years. Why would we want to wait until retirement to start that process? Let's start it today. Trust me, I have been investing for more than 15 years now. I have utilized this process and seen it firsthand, not only with myself, but with hundreds of students that I've worked with throughout my 6-week investing accelerator course. If it works for me and it works for them, oh, and by the way, it has worked for Warren Buffett, trust me, it's something that you can rely on for a number of years. So during this video, we're going to go through a number of different scenarios. We're going to start with a lower dollar value account. Then we're going to increase that size of the account and go even further up to a very large sum of money if we're starting with. Obviously, we'll see the dividend income be much higher for those higher accounts, but we're going to be focusing right now is on the process, the power of compounding dividends. So let's begin by quickly explaining what is this power of compounding dividends. Well, the idea is the fact that when you invest in a dividend-paying stock, or it could be an ETF as well, you're going to get paid a dividend, your share of the income that the company wants to distribute to its rightful owners. You being a shareholder, you have a piece of the pie, ownership in that particular company. So when a company pays a dividend, you receive dividend income. You can turn around and reinvest that back into the business. What does that do? That increases your share count. And if you're investing in dividend stocks that regularly increase their dividend on an annual basis, now you have more shares and the company is paying a higher dividend payout. So what's that mean for you at the end of the year? A higher dividend income payout for yourself. Now this process is something that starts slow, and I equate it to a snowball rolling downhill. That snowball starts slow and it starts small, but once it starts rolling downhill, it starts picking up speed and it gets larger and larger over time. So let's start by taking a look at my compounding calculator I built that you can see on the screen here. And if you've taken my 6-week investing accelerator course in the past, this probably looks familiar. In this first example, we're going to start with just $5,000. That's our starting investment in this particular account. And let's say that we're going to invest $250 per month adding into our account. What other assumptions will we include? Well, let's assume an average share price growth of 10%, which is in line with the S&P 500 roughly. The starting yield will keep around 2%. We'll keep it quite low here to start. And we'll assume a 9% average annual dividend growth rate. So by doing this, we will earn a whole Benjamin, a whole $100 at the conclusion of year one. You could see we have $5,000 invested. What does that pay us with a 2% dividend yield? That gives us $100. Nothing, obviously, to write home about. So by looking at this year one dividend income, it's easy to get discouraged. And this is where a lot of those snarky comments come from all the time, is people just doing the year one math. They say, why would you invest this much money only to receive this much in dividend income? And again, it comes back to dividend income isn't about the year one dividend income. It's about the years 10 plus. So going back to the calculator, you can see that we will reinvest that $250 per month, so that by year two, we'll be up to $8,000 of the amount of money that we've actually reinvested ourselves. This doesn't include any reinvestment. However, we are reinvesting the $100 in dividend income, but that's not money that's coming out of our bank account. That's not fresh money that we've added to our investment account. That's dividend income that we've received by owning this particular stock. So by year two, if we look, we're up to $170 in dividend income. By year five, we're up to about nearly $430. And by year 10, we will have surpassed $1,000 in annual dividend income. So in the scenario, it took us 10 years to equate $1,000 in annual dividend income. But you remember my snowball analogy, how things roll faster and grow bigger over time? Well, just 5 years later, short years later, you will over double that annual dividend income to $2,100. The compounding process is now firmly at work. Now let's change things up a little bit and let's increase this portfolio. Let's say this investor now, in example 2, is starting with a $50,000 portfolio. And instead of adding just $250 per month, we're going to add, let's say, $1,000 in monthly additions to our portfolio. We're going to use mostly the same assumptions. We'll keep our 10% share growth. We'll keep our 2% yield. But instead of 9% dividend growth, let's drop it down to, let's say, 8%, just to get a little bit more conservative. So now when we look at the year one annual dividend income, you can see we're up to $1,000. And again, that's just math there. But by year 5, we will surpass $2,500. And by year 10, we're in the ballpark of $5,300 in annual dividend income. How is this building up? Well, obviously, we're adding fresh money of our own on a regular basis, $1,000 per month to be exact. But we're also taking that and combining it with the annual dividend income that we're receiving year in and year out, which is just further increasing the amount of shares that we have now. So with that $1,000 that we received in year one, if it was a $55 stock, that's going to add just a ton more shares to our overall account. And this company is increasing its dividend at an 8% growth rate per year. Now they're paying out even more in dividend income. So if we continue this process year in and year out, you can see that by year 15, we're closing in on $10,000 in annual dividend income. And as the years progress, it isn't just math, because we aren't just adding fresh new money from our bank account into our investing account and making investments. No, we are combining that with the annual dividend income that we're receiving, which just further increases our share count. In a company or an ETF, that's increasing its dividend every single month. The snowball starts slow, but it grows faster and larger as time goes on. Now, by year 10, year 15, the process is firmly underway. Now we'll take a look at one final example here. Example 3, we're going to have a large account in this example. We're going to start with a balance of $250,000. Now, this doesn't necessarily have to be someone that's just starting out and they just had $250K in their back pocket. No, maybe someone had built up their portfolio over time and now they're thinking about building a dividend empire themselves. So in this example, instead of $1,000 per month, we're going to add, let's say we contribute $200 or $2,500 per month. We'll keep the same assumptions as we did before, 10% average annual share growth, 2% dividend yield, and 8% annual dividend growth. So in year 1, we're up to $5,000 in annual dividend income. By year 5, we nearly double that to close to $10,000. And by year 10, we are talking about closing in on $20,000 in annual dividend income. So regardless of where you start, obviously the dividend income is going to be much higher for those accounts that have a higher balance. But the idea right here is to understand the process. Everyone has to start somewhere. So if you're starting and just beginning your investing journey and only have a few $1,000s in the market, understand the process. However, if you've been investing for a while and you have a good chunk of change but haven't really been all that interested or understanding the power of compounding dividends, well, now you hopefully understand a little bit more and you can jump in. But you're probably asking yourself, well, Mark, where am I going to find dividend income or dividend stocks like this that have these types of assumptions? Where can I find a portfolio of stocks that have average 10% share growth? Where can I find to where I can average out a 2% yield or at least a 8 to 10% average dividend growth rate? Well, I'm so glad you asked because we're going to go through 10 amazing dividend growth stocks right now. All right, so let's go through these 10 stocks now. And what I'm going to do is I'm going to give you the actual name of the company. I'm going to give you, looking back over the past 10 years, what has their average annual return been just in share price. I'm going to give you their 5-year dividend growth rate as well as the dividend yield. So let's begin with stock number 1. And again, these are in no particular order. We're going to go with Morgan Stanley. Morgan Stanley over the past 10 years has averaged an annual return of 20%. They have a 5-year dividend growth rate of 23% and a current dividend yield of 3.6%. Moving to stock number 2, which is MasterCard. MasterCard has a 10-year average annual return rate of 50%. Of course, we can't come to assume 50% moving forward. That's just giving you the facts, though. They currently have a 5-year dividend growth rate of 16%, very strong dividend growth, but they have a low dividend yield of just 0.6%. Let's look at a close competitor of MasterCard next, which is Visa. Their 10-year average annual return is 42%. They have a 5-year dividend growth rate of 16%, and their dividend yield is also low at 0.8%. Stock number 4 is United Health Group. They have a 10-year average annual return of 50%, a 5-year dividend growth rate of 16%, and a current dividend yield of 1.5%. Next is Broadcom, which has been a fan favorite for many, both growth investors and dividend investors of late, as they have a 10-year average annual return of 191% per year. Definitely not something that you can become accustomed to assume moving forward, but that's what it is. They have a 5-year dividend growth rate of 17% and a current dividend yield of 1.4%. Stock number 6 is Abbott Laboratories. They have a 10-year average annual return rate of 16%, a 5-year dividend growth rate of 12%, and a nice dividend yield of 2.1%. Next on the list, one of my favorites, which is the Home Depot. Home Depot has a 10-year average annual return of 33%, a 5-year dividend growth rate of 13%, and a current dividend yield of 2.7%. Stock number 8, another one that I own, NextEra Energy, which has a 10-year average return of 19%, a 5-year dividend growth rate of 11% per year, and a dividend yield of 2.8%. Stock number 9, Texas Instruments. They've had a 10-year average annual return rate of 31%, a 5-year dividend growth rate of 12%, and a dividend yield of 2.6%. And the final stock, last but certainly not least, is AbbVie. AbbVie has a 10-year average annual return rate of 22%, a 5-year dividend growth rate of 9%, and a dividend yield of 3.7%, which is the highest on our list today. So now that we've gone through 10 amazing dividend stocks, I mean, look at the return rates on those. Not something that we can come to expect moving forward, but let's focus more on the dividend growth rates and the current yield. So let's start by taking a look at a summary of these 10 stocks real quick. So here you can see that I've laid out all 10 stocks, giving you the yield, the 5-year dividend growth rate, and how much in year 1 dividend income you would receive. We're going to evenly invest in these stocks. We'll say $10,000 each to start. So at the bottom, you can see of our summary here, we have total invested, which is $100,000. We have an average yield of 2.2%. We have an average 5-year dividend growth rate of 14.5%. And this year 1 annual dividend income will be close to $2,200. So with that, now that we have these 10 dividend stocks, we've averaged things out, let's take this 10 stock portfolio and let's plug it in to our calculator to see how those results would be after, say, 5, 10, or 15 years going through the power of compounding. All right, so now that we're back at our calculator, let's adjust our inputs. Our starting investment, we're going to work with our $100,000 portfolio that we just created. And let's say we'll add $1,000 per month to our portfolio. We'll keep our average share growth at 10%, even though those 10 stocks far surpass that, but let's stay conservative. I usually keep that in the 8 to 10% range. Our starting yield, as we saw, was 2.2%. Technically, it was 2.18, so we'll put that in. And our average dividend growth, if we look back, was about 14.5%. Now, can we expect that over a long period of time? Let's get a little bit more conservative and let's just start with a 10% average dividend growth rate and see where things take us. So as we can see here, we are starting with our 2180. 2,180 is our year one dividend income, which matches what we saw in our 10 stock portfolio. By year 5, though, you can see that we have surpassed $4,700 in dividend income. By year 10, we are up above $10,000 in annual dividend income, and it just keeps growing. And you can't slow down this snowball because by year 15, we are closing in on annual dividend income of $20,000. That is truly amazing considering we started by earning only $2,100, $2,200 if we want to round up. But if we continue with this process over 10 years, over 15 years, by 15 years, we're closing in on $20,000. Now, let's make some small tweaks here, just for kicks and giggles. Let's bump up our average dividend growth rate by 200 basis points, brings it up to 12%. Now, if you go to year 5, instead of $4,700, we're closing in on $5,100. By year 10, we're up at nearly $12,000. And by year 15, we are over $25,000, closing in on $26,000 in annual dividend income. You gotta admit, it's pretty awesome, and the power of compounding dividends is very real. Now, again, these are a lot of inputs that we put in, a lot of estimates that we make. So don't look at this and say, wow, after 5 years, I never got to that. There's estimates here. Let's try and put in conservative estimates is what I do on a regular basis. And I tell my students that I work with as they go through here. This just gives you an idea, a ballpark that you could be at if you stick with the process. Don't focus on year 1, year 2, year 3 dividend income. Focus on the longer term. Understand the power of compounding dividends takes time. Down in the comments section below, let me know what 10 dividend growth stocks would you choose to build a 10 stock portfolio with. And if you enjoyed the video, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.